Canada's trillion-dollar oil problem, the end of an era. The year is 2025. You're standing on the edge of a massive open-pit mine in Fort McMurray, Alberta. Below you, yellow trucks, each the size of a three-story building, crawl slowly across a black, oily landscape that looks more like the surface of the moon than Earth. From a distance, it looks like power. It looks like wealth. It looks like the beating heart of a G7 economy. This is the oil sands. For decades, this place was Canada's golden ticket. The reason Calgary filled its skyline with glass towers. The reason Alberta punched far above its weight. The reason the Canadian dollar rose and fell with the price of a barrel. But here's the unsettling truth. Those trucks aren't just digging up oil. They're digging up something the rest of the world is quietly moving on from, like VHS tapes in a Netflix era. Right now, Canada is sitting on an estimated $1.7 trillion worth of natural resources. Most of it locked inside the oil sands, a thick, sticky mixture of sand, water, and bitumen. On paper, that number sounds like a national safety net. Healthcare funded forever. Education secured. Prosperity guaranteed. But paper wealth has a problem. It assumes the future looks like the past, and the future doesn't. If global climate targets are even partially met, if electric vehicles keep scaling faster than pipelines, if China and the US keep building batteries instead of refineries, that trillion-dollar fortune doesn't slowly decline. It disappears. Economists have a polite word for this: stranded assets. Assets that still exist physically, but are economically worthless. And Canada is now staring straight at that cliff. By the early 2030s, some models project provincial oil revenues could fall by up to 80%. Not because Canada ran out of oil, but because the world stopped wanting it. This video is an autopsy of that moment. We're going deep into the dark side of the Great White North, into a story most Canadians were never prepared for. A story about why Canada spent $35 billion on a pipeline that may never pay for itself. Why Canadian oil sells at a massive discount no matter how much we pump. Why environmental cleanup costs could quietly explode into 260 billion Australian dollars liability. And how one of the world's most stable economies is now playing a trillion-dollar game of chicken with the future. This is not a climate morality tale. This is not an activist argument. This is about incentives, geopolitics, and cold economic math. Because the danger isn't that oil disappears tomorrow. The danger is that Canada believes it has more time than it actually does. For most of the 20th century, oil was power. It shaped currencies, foreign policy, and national identity. But history is ruthless with industries that mistake dominance for permanence. Coal learned that lesson. Steel learned it. Manufacturing learned it. Now, oil is next. And Canada, more than almost any country on Earth, has bet its prosperity on being late to the transition. The question isn't whether oil will decline. The question is whether Canada can turn today's oil wealth into tomorrow's economy before the window closes. Because once assets become stranded, no amount of pride, politics, or pipelines can save them. In the next section, we are going to expose the illusion at the heart of Canada's oil wealth, the $1.7 trillion mirage, and why what looks like abundance may actually be the most dangerous kind of trap. It's a $1.7 trillion mirage. When abundance becomes a trap, Canada loves big numbers. They feel comforting. They sound permanent. And none is bigger or more misleading than this one. $1.7 trillion. That's the estimated value of Canada's natural resources still sitting underground, according to multiple late 2025 assessments. On paper, it places Canada among the great resource superpowers of the world, right alongside Saudi Arabia, Venezuela, and Iran. It suggests safety, suggests leverage, it suggests time. But here's the first crack in the illusion. Not all oil is created equal. When people imagine oil wealth, they picture light, sweet, crude. the kind that flows easily, costs little to extract, and can be refined almost anywhere. The kind that gushes from deserts and offshore platforms. That is not Canada's oil. Canada's reserves are dominated by bitumen, a substance so thick it's closer to asphalt than liquid. At room temperature, it doesn't flow. It sits, heavy, stubborn, reluctant to extract it. You either strip mine entire forests and landscapes or inject massive amounts of superheated steam underground to melt it. Both methods are expensive. Both are energy intensive. Both are carbon heavy. This is why the $1.7 trillion number is a mirage. That valuation assumes a world where oil demand stays high, prices remain strong, and climate pressure stays manageable. A world that looks increasingly fictional. Canada is caught in a pincer movement. On one side, low-cost producers. Saudi Arabia can pull a barrel of oil out of the ground for $10, $20. Some Middle Eastern producers, even less. On the other side, the energy transition. Every new electric vehicle, every solar farm, every battery factory in China or Texas quietly lowers the long-term demand for oil. Canadian oil sits in the middle, too expensive to compete on cost, too carbon-intensive to compete on climate. For many oil sands projects, the break-even price sits between $40 and $60 per barrel. That's the price they need just to keep operating, not to thrive, not to expand, just to survive. Now imagine a future aligned even loosely with global climate targets. Oil prices dip to $30. Capital gets tighter. Investors demand cleaner barrels. In that scenario, entire segments of Canada's oil sector don't decline. They become uneconomic overnight. This is what stranded assets actually means. Not a slow fade, not a gentle sunset, but a sudden loss of economic relevance. A fleet of perfectly functional machines that nobody wants to buy from anymore, and the consequences aren't theoretical. By late 2025, Alberta was already staring at $6.5 billion Australian dollars budget deficit. Resource revenues fell sharply as prices softened, while spending commitments stayed locked in. At the same time, the province carried more than $84 billion in taxpayer-supported debt. Alberta didn't run out of oil. It ran out of margin. This is the resource trap in its purest form. When a region builds its entire fiscal structure around a commodity that no longer guarantees returns. For decades, oil revenue masked structural weaknesses. It delayed diversification. It made hard choices optional. Why build a new economy when the old one keeps paying the bills? Because, eventually, it doesn't. And when that moment arrives, the costs surface all at once. In the next section, we are going to look at the most dramatic attempt Canada made to escape this trap. A single infrastructure bet so large, so expensive, that it transformed the federal government into an accidental oil tycoon. The $35 billion pipeline that was supposed to save the industry, and may end up symbolizing the end of an era instead. The $35 billion pipe dream. How Canada nationalized risk. If you ever want to see the sunk cost fallacy at a national scale, look at the Trans Mountain Pipeline expansion. TMX isn't just a piece of infrastructure. It's a psychological artifact, a snapshot of a country caught between two eras, trying to keep one alive long enough to fund the next. The story begins in 2018. At the time, Canada's oil sector was already under pressure. Environmental opposition was fierce. Regulatory timelines were stretching into the absurd. Court challenges stacked up. Delays multiplied. Private capital noticed. Kinder Morgan, the original owner of the Trans Mountain expansion, looked at the legal risks, the political uncertainty, and the ballooning costs, and decided to walk away. They weren't activists. They weren't ideological. They were rational. And when rational capital leaves, governments face a choice: accept reality or step in. Ottawa chose to step in. In a move that stunned markets, The federal government purchased the pipeline for $4.5 billion, effectively nationalizing a major oil infrastructure project. The logic was carefully worded. Canada needed access to tidewater. Canada was too dependent on the United States as a single buyer. A pipeline to the Pacific would unlock Asian markets and higher prices. But beneath the policy language was something simpler. Fear. Fear that if TMX failed, it would signal that Canada could no longer build major projects at all. Fear that abandoning oil too early would crater provincial finances. Fear that the entire growth model was unraveling. So the state became the backstop, and then the real costs arrived. By 2024, TMX wasn't just over budget. It had escaped gravity. The final price tag, $35 billion. That's roughly $1,000 for every person in Canada, infants included. For a single pipeline? By the time TMX finally ramped toward full capacity in 2025, global conditions had shifted again. Shipping heavy bitumen from Burnaby to Asia turned out to be far more expensive than advertised. Pipeline tolls had to be high just to service the debt. Shipping costs across the Pacific were brutal. Asian refiners had alternatives, including discounted Russian crude. And suddenly, the math looked ugly. If the government charges oil companies the true cost of TMX, many won't use it. Margins evaporate. If the government lowers tolls to keep volumes flowing, taxpayers subsidize the difference. Either way, the public absorbs the risk. TMX became a paradox, a pipeline built to support a private industry, owned by the state, financed by taxpayers, to sell a product the world is slowly moving away from. A $35 billion bridge to a future that may not exist. And while TMX dominates headlines, it isn't the most dangerous liability facing Canada's oil economy. That distinction belongs to something quieter, something buried, something leaking. In the next section, we're going underground into the orphan well crisis, where decades of profit were privatized and cleanup costs quietly socialized. This is where Canada's oil problem stops being abstract and starts becoming personal. The orphan well time bomb. When yesterday's profits become today's debt, imagine waking up one morning in rural Alberta. You step outside onto your farmland that's been in your family for generations, and you notice something strange in the distance. A rusted metal pipe protruding from the ground. The grass around it is dead. There's a faint smell in the air. Sulfur, rotting eggs. That pipe is an inactive oil. Well, for years, a small energy company paid you a modest lease. Then one day, the payments stopped. The company went bankrupt. Phones stopped ringing. Emails bounced. The well became an orphan. No owner, no responsibility. No cleanup plan, just a hole in the ground. And a bill waiting for the public. This is the part of Canada's oil story that almost never makes the headlines. Because it's not dramatic. It doesn't fit into slogans. And it doesn't show up in GDP until it does. As of late 2025, Alberta is sitting on one of the largest environmental liabilities in North American history. Officially, regulators estimate the cost of cleaning up inactive and orphaned wells at $33 to $60 billion. Unofficially, according to independent analyses and leaked internal assessments, the true number may be far higher. Some estimates put it between $100 billion and $260 billion. To put that in perspective, Canada's entire federal budget for 2025 was roughly $500 billion. This is not a side issue. This is a fiscal iceberg. And the system that created it was perfectly legal. Here's how it worked. Large oil companies extracted the most profitable years from a field. Once wells aged and output declined, they sold them cheaply to smaller, undercapitalized firms. These companies squeezed out the last remaining barrels. And when cleanup costs exceeded remaining value, it declared bankruptcy. The wells became orphans. The profits stayed private. The liabilities became public. By 2025, the Orphan Well Association was responsible for thousands of sites, with an annual cleanup budget barely exceeding $140 million. At that pace, clearing the existing backlog would take more than a century. And that's assuming no new wells fail. Which they will, because consolidation accelerates as margins shrink. This is the hidden cost of stranded assets. Not just oil that can't be sold, but infrastructure that must still be dismantled, remediated, and paid for. And it's happening quietly, steadily, invisibly. But environmental liability is only one side of Canada's modern reckoning. The other is perception, because in a world of global capital, reputation matters. In the next section, we'll confront the dirty oil stigma, the geopolitics of ESG, carbon tariffs, automation, and the final paradox facing Canada's oil sector: producing more than ever, while employing fewer people, and facing a future where even success looks like decline. This is where the story stops being about oil and becomes about identity. Dirty oil, ghost jobs, and the end of the petrodollar illusion by 2025. Canada's oil problem is no longer just geological, it's reputational. Imagine you're a fund manager in London or New York. You oversee trillions in capital. Your mandate is clear. ESG compliance isn't optional anymore, it's survival. You look at Canada: stable democracy, rule of law, educated workforce. Then you open the emissions data. For decades, Canadian oil carried a stigma: dirty oil. It's not because engineers didn't try, but because physics doesn't negotiate. Bitumen is heavier, more carbon-intensive, and harder to refine. Yes, emissions per barrel have dropped significantly since 2009, a real engineering achievement. But global capital doesn't grade on improvement. It compares. And compared to light crude from Saudi Arabia or the Middle East, Canadian barrels still look expensive financially and politically. So Canada responds the only way it knows how: with scale. The industry proposes carbon capture. 16.5 billion Australian dollars bet to vacuum emissions out of existence and bury them underground. Governments offer tax credits. Companies demand certainty. Everyone waits for someone else to move first. Meanwhile, the market doesn't pause. The EU's carbon border taxes loom. Asian buyers find cheaper alternatives. Investors quietly rebalance. And then comes the cruelest twist of all. Canada is producing more oil than ever, while employing fewer people than ever. While employing fewer people, automation has arrived quietly. 3-story autonomous haul trucks, AI-driven monitoring, digital twins replacing boots on the ground. Production rises. Jobs disappear. The old promise, work hard, go north, join the middle class, fades. Oil becomes capital-intensive, not labor-intensive. The blue-collar dream turns into ghost jobs. This is Dutch disease 2.0. For decades, oil strength pushed up the Canadian dollar, hollowing out manufacturing and tech. Now, as oil weakens, there's no diversified base ready to take over at scale. Canada isn't running out of oil. It's running out of time. There is a future path. Clean energy, critical minerals, AI data centers powered by cold climates and cheap electricity. Indigenous equity ownership reshaping who benefits from infrastructure. But these aren't automatic transitions. They require urgency. Because oil wealth is only useful if it's converted before it becomes stranded. History is brutal, with nations that mistake sunsets for sunrises. Coal thought it had decades. So did steel. So did manufacturing. Canada still has a window, maybe 10 years, to use today's oil revenues to fund tomorrow's economy. If it wastes that window arguing about pipelines and pretending the past can be prolonged indefinitely, it risks waking up in the 2030s sitting on the world's most expensive pile of useless sand. The real wealth of Canada was never what lay beneath the ground. It was the ability to adapt before the ground stopped mattering. And in finance, the most dangerous words are never "this might fail." This has always worked.